good morning. Thanks for joining in. What can you tell us?
Let me just explain the transaction first, Prashant. It is quite complicated. I'll try to simplify it. Basically, you had shares of Cairn India Holdings were acquired by Cairn India Limited from Cairn UK. So, Cairn India acquired shares of Cairn India Holdings from Cairn UK, and the Income Tax Department alleged or argued that the value of these shares are derived solely from the assets located in India, and therefore they brought it to capital gain. They brought it to tax under Section 911 of the Income Tax Act, and they levied capital gain to the extent of 24,000 crore. On that, the capital gains tax was calculated at roughly rupees 10,000 crores. The Cairn was arguing that the transaction is a genuine case of group restructuring and therefore should not be subject to taxation in India. But that is not what the department held. The department, in the very voluminous order, argued that this transaction is definitely chargeable to tax. What the Income Tax Appellate Tribunal has done is basically confirm the Income Tax Department's order, and they have dismissed Cairn UK's the petition or the case that they filed in the tribunal, 166-page detailed order, and they've said that we do not find any infirmity in the order of the assessing officer, and they say we confirm the order of the assessing officer in working out capital gain on sale of shares of Cairn India Holding Limited in the hands of the appellant, which is Cairn UK, to the extent of 24,503 crores. That basically, in a nutshell, is what the ITAT has done. But the department did make a very strong case here. In fact, Cairn also argued that the reopening of assessment itself is bad in law. They had 7 grounds on why the reopening itself should not be allowed, but the ITAT has dismissed all the 7 grounds of Cairn and said that the reopening of assessment done by the Income Tax Department, in fact, is valid, and they have dismissed Cairn's contention that this transaction of group restructuring be exempt from tax here in India. And in fact, still going through the
Arun, just a very quick point. Any implications for the Indian company? I mean, because since then the company has been IPO'd and then it's been acquired by a different group. So, I mean, this is now Cairn PLC we're talking about, right? Cairn UK. The implications, if any.
The assessment is, the order has been passed on Cairn UK very clearly.
Yeah.
In fact, I can tell you exactly the company name as well. It's Cairn UK Holdings Limited.
Yeah, okay. All right.
It is, and the crux of the Income Tax Department order is that Cairn India Limited, an Indian company, has taken control of the assets and operations situated in India of the Cairn Group, which was acquired indirectly through the purchase of shares of the holding company Cairn India Holdings, which was in turn incorporated in Jersey. So what the assessing officer has said, that the capital gains arising to Cairn UK on sale of shares of Cairn India are deemed to accrue or arise in India and is therefore taxable as short-term capital gain under the provisions of the Income Tax Act.
But Arun, this would be a long-drawn litigation process, I assume?
Yeah.
Oh, absolutely. You would now expect Cairn to take this matter to the High Court to request for an urgent hearing, considering the gravity of the matter, considering the figures involved, and the substantial question of law which is involved here. You would expect the High Court to grant an early hearing, and you would definitely expect all the legals to be now arguing this matter in the High Court, and you would, of course, then have this matter quickly travel to the Supreme Court.
Okay, fair enough, Arun. We're going to let you go on that note. Thanks very much for joining in and bringing us this